Can you see the slides?
Yep, I can see him.
Okay. Oh, gas hierarchy, and we just did the financial policy to update this. Got category A and B. So A is statements, and B is technical bulletins and implementation guides. Some AICPA literature that was hired by Gatsby. And then there's non-authoritative literature that we fall back on if there isn't anything directly related. What's north? And there are areas like capital assets where that happens a lot because there just isn't much of a codification that tells us what capital asset accounting should be. They currently have a project underway to address capital asset accounting, but I haven't heard anything about the exposure draft coming out yet or anything. So we'll have to wait and see. But we do have all the statements and the codification in paper form, and it sounds like there's probably people are having problems getting to the GARs.
Right, well, we weren't able to open that database, so.
Yeah, I tried the other day and I couldn't because Svetlana was in it.
Oh, is it one way?
Only one person at a time.
Oh,
That's one of the downsides of our GARs. But there is the online version that you can just go to the Gatsby website. And, I just did that yesterday, but when I got that, I couldn't get into GARs because Svetlana was in there, so I went to the Gatsby and went into that version of it and looked up what I needed.
Is there a difference in how often they're updated?
No, I think just the amount of material that's available. There's a lot more through the GARs that you pay for.
No.
And that's part of the subscription. And we get the GARs and then we get the paper codification and standards, and then the Q&A and FAQs.
Okay,
So it's all part of one lump sum. I guess that's another thing we'll have to watch out for, is because it's probably going to Ashley. And I'd have to look back to see when the last time it was we paid it. So anyway, I suppose we should research that, to figure that out. So chapter 4, fund types and interfund activity. Fundamental goal is to use the minimum number of legal funds. And then for us anyway, I haven't seen sub funds used other places, but I'm sure there are other places that can do use sub funds, but we will break down a legal fund into sometimes dozens of sub funds, each one of them with a specific purpose. Sometimes for management purposes, and sometimes because the revenue stream is restricted or committed or assigned. Now, special revenue, you either have to have restricted or committed revenues in order for it to be a special revenue fund. Fundamentally, funds are used to isolate activity that needs to be accounted for separately due to laws, contracts, or management accounting. It gets frustrating to me sometimes because some of the bureaus do not use sub funds properly. Like Peabody, if you go in and look at Fund 200,000, Fund 200,000 itself has negative cash of hundreds of millions of dollars. But then you go down to like the gas tax sub fund, and it's got hundreds of millions of dollars of positive cash. So they're dumping the revenue into the proper sub fund, it appears. But they're spending all the money out of 200,000 of the parent fund. And then nothing makes sense anymore. The idea was to, like the gas, our local gas tax has to be spent in certain ways. The idea was to create a local gas tax fund, put the revenues in there and do the spending out of there. And then you can show an auditor, yes, we did comply with the voted ballot measures that created that tax. I don't know how they're proving that to the auditors at the moment, but it's not being done using it. The sub funds like it wasn't designed to do. So we do have a lot of sub funds, and actually we got a lot of funds, a lot of legal funds. And some people have wondered if there's too many, but I think we're okay. Types of funds. The basic types are governmental and proprietary and fiduciary. And within the governmental funds, you got general funds and special revenue, debt service, capital project, and permanent. And we have all those types. Not necessarily everybody does, but we do. And proprietary, we've got enterprise and internal service. And then for fiduciary, we now have trust, and then we have custodial. They used to be called agency funds, but yeah, they put out a standard not too long ago and changed all that. And it created some issues and some positive things, because some of our agency funds can't be custodial funds, like the our payroll clearing fund. So we have to reallocate all that money back to all the other funds and close that fund out before we do the ACFR. But one of the things we discovered as we started going through and analyzing all those funds is there was a lot of cash that was dumped into those agency funds when we went live with SAP. And my assumption was that people planned on coming back and moving it to where it really belonged. But nobody ever did until we worked on that project, and we found a few $1 million that really belonged in other funds, and we moved it. So anyway, that there was some benefit to that.
Does the financial reporting remodel affect any of the fund types?
No,
Things?
they just are affecting measurement focus and basis of accounting for governmental funds. And then some minor presentation for proprietary things like that we talked about earlier today.
Yeah.
So, but that change in measurement focus and basis of accounting is significant, and that's going to require a lot of thinking and changes. Interfund activity, you got reciprocal and non-reciprocal. And reciprocal interfund loans and interfund services. So at first, I mean, at one point when I was thinking about this, I think didn't really see why interfund loans belonged in reciprocal. It's basically a banking operation where one fund is loaning money to another fund. Over the weekend, one of the things I did was analyze the grants fund activity. and figured out that somebody's got to loan them $50 million because our billings are $50 million behind. But that's a banking operation. So that's why it's considered reciprocal. Interfund services, we've got just hundreds of millions of dollars just going back and forth between one fund and another fund. So like BES, our environmental services people will build a project and they'll want to put biosic swells in to help absorb stormwater. So they will hire parks to come in and put in the bioswell. So they're paying, we got one fund paying another fund to come in and do work for them. And PBOT does the same thing with parks. If part of their project, they want to plant some trees or something, they will hire a park to come in and plant and do that for them. So there's just a massive amount of that type of activity. And we have some of it, like when you do work on debt, you charge an internal order, which then we bill the debt office. And then the debt office turns around and bills the bureaus. And then we do like FD&R's financial statements, and we have an internal order for that, and then we bill FD&R to do work for them. So there is a lot of that type of stuff. Non-reciprocal is where you're not getting anything in exchange for what you do. So like a cash transfer. It's just one fund giving cash to another fund. And they're not getting anything in return for the money. And then reimbursements. So that's the type of stuff that they're talking about there, and we have just tons of that sort of stuff that's happening.
Is non-reciprocal the same as non-exchange?
And you can think of it as exchange and non-exchange.
Okay.
Okay, government-wide financial statements. I guess I should have been. I should pay attention to what I'm doing. I actually have a hyperlink here. Oh, this is it. This is our fund list as of whenever it was I put this together. You can see Fund 200 is PBOT, our transportation fund. But all of these are sub-funds underneath that fund. So altogether, there are 40 funds within the legal fund of transportation. And each one of them has its own specific purposes. And 211 has got a ton of them. That's where we process a lot of our urban renewal type stuff related to Prosper Portland. 220 is, and maybe the one with the most sub funds. So that's Parks Memorial Fund. So that's basically where people have donated money that they want spent on for a specific park or specific purpose within parks. There's 74 sub funds within that fund. So how many do we have altogether? 688 funds altogether. Most of them are sub funds, but even with legal funds, we've got quite a few. So What am I doing here? Oh, this is our accounting quick reference guide. That is on our website, and Delia built this a long time ago. Maybe cash between funds. So there's a little, our flow chart. So if you want to move cash, is it cash for a product or service, is yes or no? If no, it's a reciprocal or non-reciprocal. If it's yes, then it goes up this way, and that's our interfund loans and interfund billings. So that's our little flow chart we provide on our website for the bureaus. And that's a different issue. Government lines, chapter 5. Governmental activities for us is governmental funds and internal service funds. Business type activities are enterprise funds. Fiduciary funds aren't included because that's not our money. That's money that belongs to somebody else. In the case of FPDNR, which is our trust fund, that money belongs to the beneficiaries, the retirees, and the people collecting disability, the police officers and firefighters, the sworn officers. It uses economic measurement focus and accrual basis of accounting, and requires elimination of internal activity and overhead. So in our case, the internal service funds are grouped with governmental activities because basically they service every fund type. But if we had an internal service fund that just served the enterprise funds, then that one would be grouped with business type. So you have to kind of do a little bit of analysis of who the internal service fund is primarily serving. But in our case, it's going to governmental activities. So economic measure focus and accrual basis accounting, so the same as proprietary funds and fiduciary funds. And then that elimination of internal activity like we were just talking about. So if Parks and PBOT are doing business with each other, that's interagency activity within governmental activities. So that has to be eliminated. Now, if Parks is doing work for BES, that's governmental activities versus business type activities, and we don't have to eliminate that. But there's a whole big process for figuring out the look back. It's called the look back adjustment, and doing all those eliminations. And it's a somewhat complex process. It's a fun puzzle, but it's definitely requires some thinking. And I'll hyperlink there. Chapter 6, primary government and component units. The city possesses the attributes of a primary government, which is like the governing body, separate legal status, and fiscal independence. When a special purpose government does not have all three of these attributes, it is potentially a component unit of another government. So school districts are generally considered not a component unit of anybody in Oregon, but they are a special purpose government. And so for special purpose, we're talking about school districts and fire districts and TriMet, something that is targeting a specific activity.
Like water,
Hmm?
like water in some cases, not here, but
Yeah, well, like clean water services, or actually went to would be a special
okay.
purpose government. And there are a number of sewer districts and water districts in the region. Tualatin Water, and there were fire districts like over where I live, like Clackamas County has a fire district. So Milwaukee, where I live, doesn't have a fire department, and they don't have a parks department. But they go through the Clackamas Fire District and the Clackamas Parks District for fire and parks. Now, for us, we've got Prosper Portland, which is a special purpose government, and that is a component unit of the city. But they have their own standalone financial statements and their own audit. And we just include them in our government-wide statements as a column to show their summary information, and then in our note disclosures, if they have something significant, we add it to our note disclosures like cash, so we're disclosing their cash and so anyway, that's kind of. And then we go to component units. And there are a bunch of standards that touch on component units because they keep tweaking how this is. The basic attributes are financial accountability, so fiscal dependence and board appointment, financial burden and benefit, ability to impose will, blended versus discretely presented, and they must be material. So that last one for us, I think it was GASB 39 came out. And they were talking about, they were talking about nonprofits that might be component units of the city. So I went in and did a search for any nonprofit in the area that might be a component unit. And I found just dozens of them. Like there's the Friends of the Park and the Friends of Mount Tabor Park and Friends of Washington Park and on and on and on. But none of them was material in relationship to the city, so we don't include any of those. For Prosper Portland, we appoint their board. Most of their money that they make comes through us, so that there's physical dependency and fiscal financial benefit and burden. And we can definitely impose our will on them, like back in prior to FY11, 2011, they were responsible for economic development and housing in the urban renewal districts. So we decided that we wanted to take over the housing part. So we forced them to turn over all of their housing activity in the urban renewal districts to us, and they had no choice but to do it. So now they're just doing economic development in the urban renewal districts. Blended versus discretely presented. So for us, FPD and R, it is also a component unit. They're separately government, and they are blended because they exist to serve no one but us. But since they're a trust fund, they are often a trust fund. At one point, we sort of thought, I forget which GASB it was, but sort of initially looked like Prosper might have to be a blended component unit. And if they had been, then we would have had to add each of their funds to our funds. And so in our combining schedules, we would have had their general fund and each one of their governmental funds, and then each one of their enterprise funds, which would have been a lot of work. But we worked with Moss Adams and finally came to the determination that they were still a discretely presented component unit. which, like I said, basically just means that we include a column in our government-wide statements with their summary numbers, and then include their major disclosures in our notes. So there are flowcharts that exist that if we were to bring on consider another entity to be a component unit, we would walk through that flowchart, and it would kind of lead us to the A, are they a component unit, and B, are they blended or discretely presented? So, but it would take something pretty big in order to end up being material enough to be included in our financial statements. So, chapter 7, we're back to measurement focus and basis of accounting, and keep coming back to this because it's just so important in understanding accounting. So again, the measurement focus tells us what we're going to measure, and the basis of accounting tells us when we're going to measure it. So for governmental funds, we're using current financial resources measurement focus. And for the other types, we're using economic resources measurement focus. Now, the new model that they're proposing would be replacing current financial resources with short-term measurement focus. And that would be for the governmental funds. The measurement focus defines what elements we measure. Current financial resources measurement focus, we're looking at assets, liabilities, and deferred items that affect near-term liquidity. And the assets are available within 60 days of year end to pay the liabilities owing at June 30th. For economic resource measurement focus, we're looking at all the assets and liabilities and deferred items owned and owed at year end. Now, for current financial resources, as we talked about in an earlier session, one of the fundamental flaws is that there is not a solid conceptual framework that it's built on. It's just kind of, well, this is how we've done it for the last 100 years or 50 years or whatever, however long it's been around. It's been 1980, I think, was when the NCGA came out, and it kind of established kind of the current framework, but really that just kind of formalized stuff that, I mean, prior to that, it was like GFOA's Blue Book was the codification. So anyway, it's been around for a long time. But economic resources, we're getting closer to the for-profit type of model, except for the deferred inflows and outflows, which only exist in government as far as I know. Basis of accounting, that dictates when we measure something. Accrual recognized elements when they're incurred, regardless of when cash is received or dispersed. Modify accrual revenue has to be earned and available within 60 days of year end. Now, technically, NCGA 1, all they did was specify 60 days for property tax receivables. But most people have just applied, and we have done this, applied the 60-day rule to all receivables. But some governments will pull out different revenue streams like grants or something and say, okay, for grants, we're gonna be 90 days, and for property taxes, 60 days, and so on and so forth. So they'll analyze the flows, that for simplicity's sake, we had just stuck with 60 days of recognition for everything. Liabilities have to be relevant to near-term liquidity, only to the extent that payments will be made using available resources. Now we offset our receivables not collected within 60 days with deferred inflows. And that falls into, we've been calling that unavailable revenue. And spending is considered expenditures rather than expenses. At one point, they toyed with the idea of calling it revenditures instead of registered revenue. Because that's one of the confusing things is we call it revenue regardless of the basis of accounting, but really the revenue recognition rules for modified accrual are significantly different than accrual. Now I'll tend to say full accrual, but technically in the codification, it's just really a accrual. But now we're just pretty much just doing estimates for what's going to be collected within 60 days, which can be tricky, especially when things have been so odd here over the last 2 years. And when you get into odd times, it's harder to come up with a good estimate of when things are actually going to get collected. And we've had some odd ones. I mean, we definitely overestimated the receipts of property taxes last year. And as a result, property tax revenue was negative into December. And the year before, we really messed up the estimate of lodging taxes receivable. And it was actually like, I think March or April before we actually had positive lodging tax revenues. So it makes things a little bit more challenging to issue fast like we try to do, because we have to rely on estimates, and history is a good way to do our estimates. Chapter 8, categories of transactions and events. So you always want to keep coming back to what was the economic substance of the transaction. Exchange transaction is where parties give and receive equal value. When payments is received prior to an exchange, it's recognized as a liability. We call it unearned revenue. And right now we got millions of dollars with that, and we're about to receive another 100 million of ARPA money, and that'll all be unearned revenue until we actually spend the money in accordance with the rules that are guiding ARPA. And governments exist to provide services rather than to make a profit. So often the government charges or pays less than an equal value. And those would fall into the non-exchange transaction category. So that's starting to get to some of what we need to be looking at. But whenever I'm looking at a transaction and trying to figure it out, I always start by just trying to figure out what was that economic substance behind the transaction. And once you kind of figure that out, then you can start piecing together everything else. Non-exchange. So we've got derived taxes, which are income taxes or sales tax. And
I
that's
see.
derived on an underlying transaction, like how much money we make. And that drives, how much, income tax we have to pay. We don't deal with, sales tax too much here. But we do have that new clean energy fund tax, which is basically a sales tax. And you recognize it when the underlying transaction occurs. So with the sales tax, every time the cash register rings up a sale, we have a right to our money and we have earned that money. So under modified accrual, we've established the first step of recognizing a revenue. We've earned it, but it may not necessarily be available to pay short-term bills. So we have to recognize the receivable. And I'm in the process of talking to Revenue Division about that clean energy tax. So far, we haven't recognized a receivable, and we've been taking the stance that we just don't have enough historical information to derive an estimate of what that receivable is. But it's been going on for a couple of years, and it's a really big number, so I've talked to Revenue Division about trying to come up with an estimate this year. It'll probably all end up, or a big part of it will probably end up being deferred and unavailable, but at least we've made an effort to recognize the receivable. So imposed non-exchange, like property taxes and fines and penalties. So there really isn't as tangible a connection like you got with income taxes, but property taxes. Here it's kind of weird because we have assessed value rather than real market value that the tax is based on. No, I'm my assessed value is way below the market value of my house. Government mandated. So our share, our local gas, local share of gas tax collected by the state. So for the state, it's a tax. But for us, we're just getting, based on a formula of population and road miles, we get a share, just like the counties and cities all over the state. And we recognize that when all the eligibility requirements are out and voluntary non-exchange is like expenditure driven grants. And so back to the ARPA, that's an expenditure driven grant. We can't recognize the revenue until we've spent the money for something that is within the scope of the final rule that the U.S. Treasury put out. So those are the basic types of non-exchange. Now, if they do what they talking about with switching to performance and non-performance, we'll have to go back and revisit all these revenue streams and come up with something different. So unusual events, we've got extraordinary items. So for us, that would be an earthquake because it's abnormal and infrequent and unrelated to anything that we're doing. But if we were in Florida, a hurricane wouldn't necessarily be extraordinary. And for whatever reason, really understand it, but GASB came out with a ruling on the pandemic and said it wasn't an extraordinary event. Special item, again, it's unusual and infrequent, but that is under control of management. So a number of years back, we were working on a filtration system for the water people. And the state DEQ came out and said, okay, well, you don't have to do that. So we just wrote everything off that we had been capitalizing. And that was a special item because we made the decision to write it off. In retrospect, maybe we shouldn't, because 2 years later, we were required to do it, so. Anyway, and then prior period adjustments. So we're correcting for an error in the prior year or a change in accounting. Now, there's a new standard that is redefining all this a little bit, and we'll be implementing that, I think, soon. But yeah, it's, you know, we need to go back and look at the at that standard and figure out when we need to implement it and what the ramifications are. But if I remember correctly, it didn't change things too much. And these are things that don't happen a whole lot, and we don't have to deal with them now. Changes in accounting come up every time there's a major change to accounting standards. And we'll have to add something out at the end of the SOSAP telling what the impact of GASB 87 was, but its impact on that position and fund balance shouldn't be too big. But we need to disclose the assets and liabilities, and because those did change. Chapter 9, revenue recognition for governmental funds. Accrual basis revenue is recognized when I'm taking a claim to resources, regardless of when the election occurs. Modified accrual revenue is reckoned when it is collected in relatively near future, so earned and available. Net revenues against estimated refunds. And we set up an allowance for uncollectibles if material. And when received in advance of earnings recognized as a liability. And occurring that revenue doesn't change revenue recognition significantly, we can use the cash basis, so like the golf fees. Now, for us, if you look over the enterprise funds, technically for budgetary schedules that should be modified accrual revenue recognition, but we just basically use accrual for them. The places where we focus on modified accrual revenue recognition is like property taxes and assessments. So that's where you see it. But all that will change with that new short term, because it's short term basis measurement focus and accrual basis of accounting. But there are some weird things about it that I think are odd, but there are weird things about modified accrual that I think are odd too. So revenue recognition in the governmental funds derives tax revenue like the clean energy. We recognize the receivable as soon as the underlying transaction has taken place. And a portion of the receivable not collected within 60 days year end should be offset with deferred inflows. And the net receivable against estimated refunds, set up an allowance for uncollectibles. We don't do a lot of estimating of refunds. It's just not material. But for some receivables, we do set up uncollectible amounts. If you look at notes receivable, it's actually most of the receivable is offset by, like I haven't looked at it in a while, but, notes receivable is hundreds of millions of dollars, and we just recognize it, as potentially collectible, a few million of that, so. But that's another project we need to, at some time, go back to. We talked about it, but, we really, and we looked at it briefly a few years back. But we really should be going into each of those types of loan receivable that housing has. And really coming up with a better methodology for estimating the uncollectible amount. Housing, when we were talking about it with them, felt like the allowance is way too high, and we would actually collect more than what we're estimating to be collected. So the estimate we're using is really conservative. So it's probably not a huge problem. But if we're going to change it, we're going to have to do some analysis and really come up with a solid methodology for how we do that. I mean, what we're doing now was created by Prosper Portland many, many years ago, and it hasn't been looked at since. Imposed non-exchange, so that's like property taxes, recognize the receivable as soon as we obtain enforceable claims, which is usually October, November. And then we set up a receivable, and that's just totally offset by deferred revenue. So basically, no revenue recognition when we set it up. It's just numbers that are put on the balance sheet so that we're telling the reader that this is how much we're owed. And as the money comes in, we reduce receivables and deferred inflows. And then in June, we estimate the county's July and August collections and debit, deferred inflow, and credit revenue. Now, since we don't receive the money until a month later, we're actually estimating July, August, and September turnovers, because the September turnover was collected by the county in August. So I could see that argument. I could argue the other way, but we've been doing it forever like this. So for consistency's sake, it makes sense. We also estimate estimates and adjustments and correct the receivable and deferred inflow. So like in Oregon, if you pay your property taxes early, you get a discount. So you actually have to go back and reduce the original receivable setup because it wasn't really what was collected. And fines and forfeiture recognize receivable when the enforceable claim exists and revenue when received. So all of this gets complex for us, and we've got an access database, which I keep worrying will die.
Today, correct. Is there any in mind replacement for that system? No.
No, we looked into whether SAP could actually handle it, but they weren't able to come up with any way of doing that. I think we'll probably at some point need to talk to Beaverton and Hillsborough and some of the other cities around and figure out how they do it. This was created back, the access data was created back in the 90s by somebody that worked in the reporting section, and so far we've been able to keep it running. Our bill has been able to keep it running, but It's always a little bit worrisome. But once we go to the new model, that all of the deferred stuff goes away. Because we're switching from modified accrual to accrual, so we won't have to deal with that estimating how much is deferred and collected in 60 days, and all that stuff will go away under the new model. We'll still have to make an adjustment for the discounts and get that the receivable cleaned up, but that will simplify our life. So that's one positive aspect of that new model. Government mandated non-exchange, so like the city share of state gas tax. State mandates that we provide street infrastructure, and they give us a portion of the gas tax they collect. Recognize the receivable when we meet all the eligibility requirements, and recognize the revenue when available. And here we don't even really bother with the receivable. We just book the money as it comes in. Which normally we get a payment every month, is my understanding. So the timing differences probably don't. It probably doesn't make any major difference. Now it might have during COVID because gas sales crashed during that period. So we might have had an anomaly during that period. But we just haven't worried about it because it's not material. So expenditure driven grants. We set up the receivable when the eligibility requirements have been met. And payment in lieu of taxes built. So like nonprofits don't owe property taxes, but they may, like if they want in particular police services or something, they might come in and negotiate a bill rather than paying property taxes. And pass-through grants, we don't recognize the revenue until send the money on to the recipient. And it seems like there was one weird technology grant that BTS got where all we did was receive the money and immediately send it on to somebody else. So in that case, we ran it through the custodial fund, and we didn't recognize revenue and didn't recognize an expenditure. Now, under the custodial funds have inflows and outflows. So we are showing inflows and outflows there, but not quite the same thing as revenue and expenditures or revenue and expense. Go to capital assets. They aren't recorded in governmental funds if it is used in operations.
So
And
what if it's not used in operations?
then we would put it on the balance sheet as assets for resale.
I see.
That wouldn't be a capital asset, it would be just something we're gonna turn around and sell. And we had that in housing for a while, initially when we took stuff over from Prosper, housing over from Prosper Portland. We got some land. And initially, their plan was, okay, we're gonna sell this land because we don't have any use for it. But they have since changed that, and it's all that land has been reclassified to capital asset now. Because what they'll do is they'll work with a nonprofit or somebody who wants to build a house or build an apartment building. And we'll say, okay, we will lease you this land for 100 years at $1 a year. And in exchange, you will keep this property as affordable rent rate for 100 years. So we've kind of leveraged that land to help with the housing the housing issues. Special assessments. So LIDs. These are exchange transactions and property owners get improvements equal to what they pay. So we talked about that a couple weeks ago, where we set up a local improvement district. And we provide sewer or water or streets or sidewalks or whatever it is that the property owners are wanting. And in exchange, they pay assessments for 20 years and we sell bonds and do the work. And they get what they want and we get reimbursed for the cost of it.
So LID, it's not the same as the urban renewal areas, right? Or is it?
Right.
Different?
So an urban renewal district is basically where the city council has come in and said this area is blighted, and there's definitions to what blighted means. So they will take a chunk of land and create an urban renewal district. And we'll talk about it more at some point. But then they use the tax, what's called the tax increment money from that district to do work in the district to try to get rid of the blight. And it's kind of a fascinating process. Donated assets, we have a lot. PBOT, water and BES all get a lot of stuff donated from developers. So somebody comes in and builds a subdivision and they donate the streets to PBOT and the water mains to water and the sewer mains to BES. But for modified accrual and current financial resources, that's not a cash transaction, so we don't have any kind of revenue or expenditures there. So we do recognize it as revenue for accrual base. So it does show up over there. And I think that's probably a good stopping point. So let's see. Now, stop
Yeah.
recording.